Just gonna start in a couple of minutes, guys. All right, cool. Thanks, Yogi. Thanks for that feedback. Turns out that I am audible. Just give me a second, guys. Just starting up very, very soon. Hi, guys. How's it going? How is everybody's Sunday? You guys can see my screen, right? Just type in the chat, guys. You can also, you're welcome to unmute yourself also, I always prefer interaction, which is why I haven't done any pre-recorded videos here. It's always interested to gauge. See, this is a complex topic. And today is going to be the hardest lecture till now. Okay. I rushed through some, or rather, I gave you some concepts last time, right? I said that your gamma PNL is going to be exactly the same as your theta PNL. The PNL that comes from your gamma is going to be exactly the same as the PNL that comes from your theta. And then I told you that your actual PNL will depend on Vega and the difference between IV and RV, right? So these are the two things that I had said, and these are very fundamental. Uh, these are very fundamental to options trading, to understanding what actually works in option trading, what actually makes money, what drives our PNL in the long run, right? There's maths that you can use to derive this. I'll show you that, but it's completely optional in the sense that you don't need to know the maths in order to trade options successfully. You need to know the final result. And I've worked with so many traders, really smart guys who traded a lot in the American markets, and they had no idea about the maths, like how to actually derive the maths, right? It was more just they knew the concept, and um, they knew how to apply it, right? And they knew how to identify it. So we'll start with a little bit of a recap. Um, Okay, so we looked at the Greeks last time around. These tell us how the option prices move with respect to different things that affect the option price, and consequently, they tell us how your PNL will move with respect to different things that will affect your PNL, right? So delta tells us how the option price will move as the underlying moves, right? It tells me how many shares, equivalent shares, is my option behaving like, right? Or my actual position, how many equivalent shares. Um, so if let's actually build a hypothetical position here, right? Screen, share, Chrome, good old strategy builder. Yeah. So now let's say I sold this straddle. इसको क्या हो गया? Weird. ऐसा तो पहले कभी नहीं हुआ. So let's refresh this once. So let's sell this straddle. Maybe let's buy this iron fly. Multiply by lot size. So if Nifty has if Nifty is equivalent to, the Nifty future is equivalent to 75 shares of Nifty because it's 75 lots, right? Right now, I'm short like 3 shares of Nifty, right? That's what the delta tells me. My position delta tells me that. How much is my um, position, my option position, how much is it behaving like the underlying, right? Theta tells me how the option price will change as time passes. Like what we show as theta on algo test is so let's remove this. So this will show me a more broader effect of theta. So we actually show theta in terms of rupees. Okay, if I hover over this, it says your position will make 2096 rupees as 1 day passes. It's somewhat incomplete, this tooltip, because it will make 2000 rupees 96 paisa as 1 day passes if nothing else changes, right? If everything else stays the same, I'm going to collect 2000 rupees 96 cents. Oh, sorry, 2000 rupees, 2096 rupees if nothing changes. Um, that will be my total PNL. But if other things change, if the underlying moves along with this, I'm going to still collect this. But my overall PNL will be different from 2096. Okay? So, but theta is just telling me, how my position will, how my PNL will change as time passes. In the case of a single option, it's telling me how the option price changes as a day passes, and nothing else changes, right? Vega is telling me that. So again, there's two perspectives here, right? One is my position Vega. What is my position Vega telling me? And then what is the Vega of an option? The Vega of an option says that it tells us how the option price changes as the implied volatility changes, right? That's what the Vega of the option is. And I care about the Vega of my position. The Vega of my position is, I should actually note that down. That's a good way to differentiate, right? So delta of the option and delta of my position. These are two distinct concepts, right? Position. So the delta, let's look at Vega, right? So the Vega of the option just tells me, hey, how is that option price going to change as the IV changes? And then the Vega of my position, which is what I call position Vega. So what we show over here again is the position Vega, right? How is my um, PNL going to change as there is a change in the implied volatility? So in this case, I'm short Vega, right? I've sold options. Selling options means I'm going to be short Vega. And here it's saying that this is how much you expect to lose if implied volatility goes up by 1 point as you hover over this, right? So that's my position Vega. We're all clear on these Greeks, right? They're just since the option price depends on these things, it depends on the underlying price, it depends on time, and it depends on IV. It depends on other things also. But these are the main things that we care about. We will care about other things as our position gets bigger and more complex. But for us, simple option positions may we only care about these three for the time being. Right? The underlying price, if that moves, the option price will change and subsequently our PNL will change. As time passes, the option price will change and subsequently our PNL will change. And as IV changes, right? So, so we look at these numbers because they tell us in a very condensed manner. They gave us a nice little summary of our option position. Okay, hey, this is how my option position is structured right now. Okay. Let's go back to the slides. Okay, and I haven't talked about gamma right now. So gamma is a second order derivative, like I said, right? So it essentially, if you guys remember calculus in class 12 maths, right? Gamma is the second order derivative. dy by dx मेरा first order derivative होता था. That used to be the first order derivative, and then d2y by dx squared was the second order derivative, right? So it tells us how the delta changes as the underlying price changes. And we also saw in the last lesson that for option buyers, gamma works in the favor of the option buyer, right? And I'm repeating these concepts again and again. This is the third class in a row where I'm repeating this concept, right? Because these are very important concepts. Gamma on its own doesn't mean jack shit, but gamma for my position matters a lot, right? If I'm long options, I'm positive gamma, I'm holding positive gamma. I want the underlying to move. I want the underlying to move so that I can scalp that gamma, capture that gamma, right? If I'm an option seller, gamma is working against me. I don't want the underlying to move, right? Because if the stock goes up, all of a sudden I'm losing money because I'm short I'm short the underlying. It's almost like I've sold the underlying and the underlying has gone up, right? Same if the underlying goes down. It's like I bought the underlying and the underlying has gone down. As an option seller, gamma is painful, right? So in the last class, what I had done was I created two fake paths, right? One was this ping pong, ping pong, ping pong path, and we were delta hedging. And the other one was sort of a trend following path, and we were delta hedging in that also. And in both these cases, guys, the realized volatility was exactly the same, right? I'd built these paths in a way that I wanted the realized volatility to be the same. And then what we were doing was we were delta hedging essentially, right? In the first case, we saw that we were able to capture a lot of that movement, a lot of the movement in the underlying through our delta hedging. And this is also called gamma scalping, right? So as the underlying goes down, our delta becomes short, and to become delta neutral, we end up buying. Same on the other side, if the underlying goes up, our delta becomes long, and then we end up selling, right? So the effect of that is buy low, sell high, buy low, sell high, buy low, sell high, and we keep capturing that difference, right? And that's what's called gamma scalping. So so I showed you guys that example, and then we moved on to the sort of fundamental results, है ना? जिसमें let's move to the next slide actually. So I wanted to tell you guys about the relationship between theta and gamma then, right? So before I do that, I want to make you guys think a little bit about theta decay. What do we mean by theta decay? So this is an open question for you guys. Okay. The spot is 23,500. The strike is 23,500. I've just done this to match Nifty. The IV is 13%. That's to IV. And expiry is around 4 days. The price is 127.59. Exactly, right? So what is my intrinsic value, guys, and what is my extrinsic value? Batao mere ko. Just post in the chat, guys. Motorola Edge 50 Pro has already answered correctly. What is this Motorola Edge? क्या डाला? Intrinsic value or extrinsic value? Extrinsic value is the same as time value, right? This is like, correct. Intrinsic value. सही बोला Motorola Edge 50 Pro. Who are you Motorola Edge 50 Pro? अपना नाम भी बता दो यार. I don't want to keep saying Motorola Edge 50 Pro. Sagar. Cool. ठीक है. So correct वो. So my intrinsic value is 0. I'm just filling it here, right? And my time value is exactly the price of the option. Okay, so I just filled it out over here. And everybody should know this. This is like options 101. Okay, na? We are actually in an advanced options course. So this is options 101. Everybody should know this. If you don't, I'll share some Zerodha Varsity links with you. But ye to everybody should know this. Okay. Let's look at the other case. Next slide. Now, all of a sudden, everything is the same. But the spot has moved like crazy. Okay, and this is the price, and you can actually plug this in the Black-Scholes calculator and you'll get the value. These prices are exactly from there. Okay, batao yaar, what's the intrinsic value? What's the time value here? Om, Sagar, everybody else. I'm waiting. What's my intrinsic value? Koi to bolo. What's my intrinsic value? What's my time value? It's like a very basic part of the lecture. Things are going to get more interesting afterwards. Sorry, call option. My bad. You can actually tell it's a call option also, right? How can you tell it's a call option, Hemant? Obviously, you can tell by the price, right? If this were the put option, it wouldn't be 13% volatility. It would be a much higher volatility because it would be an out of the money put option worth 1,500 rupees. That's totally crazy, right? I would be selling this option if it were an out of the money put option. But it's a deep in the money call option. All is intrinsic. ठीक है ना? So Sagar, unfortunately, इंट्रेंसिक लिखा है तुमने. मुझे नहीं पता तुम इंट्रिंसिक बोल रहे हो एक्सट्रिंसिक बोल रहे हो सागर. इसमें theta is exactly 0, Vikas. That's correct. Extrinsic value in this case is going to be 0, and everything is my intrinsic value. ठीक है. Call is deep in the money. So these are two extreme examples that I've just shown you guys. यहाँ पे मैं call लिख देता हूँ. चाहे call हो या put हो, it doesn't matter in this case also, right? If it's a call or a put, same thing over here. Over here, we obviously know it's a call option. ठीक है. So in our first example, notice that since the intrinsic value is 0, right? I've also locked in my maximum time value that I can gain over the life of the option. This is the time value. 127.59. This is the price. Let's say I sold this option. Okay, so I sold this option at 127.59, which is the fair market price. And now that I've sold this option at 127.59, with 4 days to go, can anybody tell me what is the theta that I'm going to collect over the life of the option? If I've sold this option at 127.59. Vikas, exactly correct. Looking for other answers here. Complete premium, Mohan. That is exactly correct. Vikas, Harshit, बिल्कुल ठीक बोले. ठीक है ना? तो the moment I sold this option, I've also locked in the maximum time value I can gain over the life of this option. This is the sum of all the theta I will collect over the life of the option. This theta number is not going to increase or decrease as I get closer to expiry. Okay, it's fixed. As soon as I sold this option at this particular price, this is the maximum theta I'm going to collect. I've locked this price. Okay. But is this going to be my overall profit at the end of expiry? Yes or no? What else is my profit going to be dependent on? Delta. The underlying, right? How much is the underlying going to move? ये तो मेरा lock हो गया. This I'm collecting anyway, right? This is not going anywhere. This money is directly a proportion of me selling it at this price. This is mine now. This is completely, I don't have to give any of this back if it expires at exactly this price, right? I don't have to give any of this back. This extrinsic value, whatever I've collected is mine. Okay. If I would have sold it at a higher IV, then I would have collected a higher amount of time value because the price would have increased. Right? That's clear. If I would have sold it at a lower IV, I would have collected less theta. Okay, so this theta is fixed as soon as I enter my trade. I will get this decay no matter what. If the stock goes up, if the stock goes down, this decay I'm collecting no matter what. So the moment I lock in an IV, right? The moment I lock in a price, the extrinsic value is mine if I'm selling the option, right? The higher the IV is going to be, the higher the theta decay is going to be, right? Because this price is going to increase. I'll just show it in the Black-Scholes calculator as well. ठीक है, तो यहाँ पे let's say 23,500 मेरा था, interest dividend मैंने 0 कर दिया, and let's do calculate. So 127.59, I directly got it from here, right? I increase this to 40. Now this is how much I'm going to collect. This is going to be my theta is increasing. This is my daily theta, that's increasing, and the premium at which I sold this is also increasing, and it's just dependent on volatility, IV. ठीक है ना, volatility percentage लिखा हुआ है, but हमारे लिए when we price the option, we say it's based on the IV, right? So let's go back to 13%. So the reason I'm saying this is, because what we are getting towards is theta my edge? Am I like, what is edge? Do you guys remember what edge is? People say theta is edge. There's a lot of sort of understanding, hey, I'm collecting theta. I want to sell options because I want to collect theta, right? So theta is just, it's fixed. The moment you sell the option, it's fixed. Okay, the moment you pay for the option, it's fixed. This is the amount of theta that you're going to pay over the life of the option. It's not going to change. Okay, it's a fixed amount. It's deterministic. It's something that you can just see in the option price. Are itni extrinsic value, then this is the theta that I'm paying, right? And my overall P&L this is just one component of my overall P&L, right? It's just one small component of my overall P&L, whether I'm buying or selling. Theta, मैं तो ये बोलूंगा theta तो fixed है यार. Like when it's not any kind of edge. Edge means if I put this trade on again and again, I will make money in the long run, right? Nothing about this trade tells me whether I'm going to make money in the long run or not. Okay, so theta has nothing to do with edge. It's just a number which is saying, okay, this is how much money I'm collecting today, right? I will collect this money every time I put this trade on, right? 13% wall, spot is this, strike is this I'm collecting every time, right? But this is not telling me whether I'm going to make money or not. Okay, so just want to give you guys this understanding that theta is just a number that's coming. I'm going to collect it no matter what when I'm selling the option. It's not so let's say I sold this option, right? I sold this option and then immediately the stock went to 25,000. Now I've collected my theta. I've already collected my theta. Harshit, I'm going to show you some maths right now. Okay, na, after this, then you're going to have to believe me. I know your position, but I differ. Tum bol rahe ho. I'm just going to show you some maths. Okay. So, and I have to show maths to the non-believers. So, as soon as I sold the option, the underlying moved to 25,000 and I've just lost a lot of money, right? So, whatever theta I collected is mine. And now I have to pay the buyer of the option the difference between the theta and this price, right? So my theta was fixed. I didn't know what the underlying was going to do. There was an anticipation that the underlying will do something, which is why I collected the theta, which is why I sold the option. I collected the theta. I would have wanted the underlying to do nothing, but the underlying has now moved aggressively against me, right? So so in this case, my overall profit or loss is I've collected the theta. Now the stock has moved against me. So in this case, I've lost money, right? So this aggressive move that the stock made is what we call like it's part of the gamma effect. If the underlying moves up aggressively, I'm screwed. This was the effect of gamma. And theta is related to implied volatility because when I sell an option, right, I'm locking in an implied volatility. This is the implied volatility at which I sold this particular option. And the same goes for buying the option, right? So the theta that I collect is directly related to the price at which I sold that particular option. The higher the price I sold that option at, the higher the IV at which I sold the option, the higher is going to be my theta, right? But to offset that theta is the gamma. That comes from the move in the underlying. If the underlying moves aggressively, whatever I've collected in theta, I'm going to have to give away to gamma. Okay, so this is, I'm just trying to build intuition over here. There are actually a lot of components of your P&L. Options are a very dynamic instrument, but there are many components of your P&L, but these two are the ones that are most confused. People confuse these the most. And for guys that are doing, zero DT, these two are going to drive your P&L more than anything else. Okay. So, and they're offsetting forces. Okay. So I'm just trying to build a little bit of intuition right now because now I'm going to get into the maths and some like theory, finance theory, right? To actually prove to you guys how to think about, like, how did Black-Scholes, the guys who created this option pricing framework, think about this, right? तो उससे पहले, like, there is this fundamental concept in finance. It's called law of one price. Okay, and this is, I want you guys to think over here. So there are two securities, A and B. Price of A at time 0. आज की बात करते हैं. Today the price of security A is 25 rupees, and we know that the price of A at time t equals to 1 year from now is going to be 100. ठीक है. There is the second security B. We know that today its price is 50, and 1 year from now its price is also going to be 100. ठीक है. Do you guys see something? Like, can I trade A and B? Can I put a trade on between A and B today that will give me a riskless profit 1 year from now? Is there an arbitrage here? मेरे को बताओ. I can, and the game is I can buy A, sell A, I can buy B, sell B. I can do any of these two things today at t equals to 0. And I can buy as many of A as I want to, and I can sell as many of A as I want to. Same with, I can buy as many of B as I want to right now, and I can sell as many of B as I want to. SK wrote A. Yes, you will buy A, but I don't want to. Okay, so if you buy A, somebody said I'll just buy A. If you buy A, you're still giving away 25 rupees from your pocket. I'll say I don't even have 25 rupees. I'm just like, can I do something where I don't have to pay a single rupee today and I still make money 1 year from now? Is there something I can do between A and B right now? Think about it. How many A should I buy? SK answering you. SK said buy A, sell B. Right? Sagar also said buy A, sell B. Okay, let me buy A. I bought it for 25 rupees and I sold B for 50 rupees. 1:2, exactly. Right? So what I'm going to do is, if there's an arbitrage here, I'm going to buy 2 of A and sell 1 of B. Right? वापस आ जाते हैं यहाँ पे. एक मैंने B खरीदा, मुझे 50 रुपए मिल गए. उसके मैंने 2 A खरीद लिया. ठीक है. Today I have 0 rupees in my pocket. But this is my position. My portfolio value is 2A minus B. Right? I bought 2 of A and I sold 1 of B. Okay. So 2 into 25 minus 50 equals to 0. Net cash flow is 0 over here. Right? Sorry, Harshad. I'll repeat it for you, man. I'll repeat it for you. So basically, ये मेरी position है. Like, there are these two instruments, A and B. I can buy and sell as many of these as I want to. And I'm just saying, hey, can I create a riskless profit here? Can I create an arbitrage here? Knowing that it's an arbitrage, right, SK? Okay, I'll repeat again, BT Raoji. So we are in a theoretical world over here. This is a concept in finance, and I'm mentioning this because it's going to be directly related to options right after this. Okay, so I have 2 securities in my universe, security A and security B. ठीक है. आज A की प्राइस है 25 रुपए, B's price is 50 rupees. And I only have 2 time periods, today and 1 year from now. ठीक है. It's a very simple experiment. I know that the price of both A and B 1 year from now will be 100 rupees. So can I create an arbitrage over here? Can I like buy and sell A and B in a way where I make a riskless profit? Right? And the answer is yes, I can. If I do a 1:2 ratio, I can buy so what I'll do is I'll sell B first. The moment I sell B, I've received 50 rupees, right? And I have a short position in B. And then I'll invest those 50 rupees by buying 2 of A. Okay, so my portfolio now is 2A minus B. right? And my cash flow is 0. By having a net cash flow of 0, I hold this portfolio 2A minus B, right? And 1 year from now, I know both A and B are going to be 100 rupees, right? So my profit 1 year from now is 100 rupees because A की भी value 100 है, B is also 100, but I hold 2 aways, right? So I've created this sort of interesting thing where with net outflow of 0 rupees today, I'm getting 100 rupees in my bank 1 year from now. Okay. So in finance theory, this is called arbitrage. Practically also, this is called arbitrage. And all finance theory is built on the idea that arbitrage is not possible. Okay. So law of one price says this. Exactly, Harshit. I'll get 100 rupees after a year by giving 0 rupees today. Right. So the law of one price says that if there are two instruments, both have the same cash flow, right? At a future time, if they both have the exact same cash flow at a future time, they should both have the same price today. That's what the law of one price says. It says that if sometime in the future, these two instruments are giving me the same cash flow, right? Then today they have to be worth the same thing. If they are not worth the same thing, I can create an arbitrage, right? So there should be no arbitrage. That is what the law of one price says. And it's a very fundamental concept in finance. This is what all pricing is based on. It's based on the idea that, hey, there is just one price, law of one price. You cannot have arbitrage. Cash flows in the future will always map. If the cash flows in the future are the same of two different instruments or a combination of instruments, then today their price will have to be the same. So this is exactly what the Black-Scholes model is also based on. Why am I giving this example? It's a very simple example. So the creators of the Black-Scholes model were able to do the same thing with options. They figured out that a call option over a small time period, behaves exactly like a small amount of shares, like a specific amount of shares. So I can hold a call option as an example. Either I can hold a call option or I can hold a specific amount of shares. And for small moves in the underlying, my P&L will be exactly the same. So at time, like instantaneously, like 1 second from now, if I'm holding an option, if I'm holding a call option and I'm holding X amount of shares, for small moves in the underlying price, my P&L between both of them will be exactly the same. So the cash flow in future of holding an option and holding some amount of shares in the future will be exactly the same, right? Can anybody tell me what that amount of shares is going to be? What did they call? What did Black-Scholes and Merton, BSM bolte hain? What did they call that amount of shares which is equivalent to holding that call option over a small period of time? What is that called? What is that number of shares? It's the delta, guys. So what they said is, they said कि देखो यार, I won't come here right now. So they said कि I can either hold a call option or I can hold delta amount of shares. If I hold the call option, if the stock moves up a little bit, if the stock moves up by 1 rupee, right? How much money have I made? My call option has gone up by how much? Delta amount, right? Right? Everybody with me? If I bought a call, yeah, exactly, right? If I bought a call, stock goes up by 1 rupee, my call will go up by the delta amount. In the case of an at the money option, my delta is 50, 0.5, right? So if the stock goes up by 1 rupee, the call option will be worth 50 paisa more, right? So So their insight was same on the other way, right? If the stock goes down by 1 rupee, the call will lose how much? The delta amount, right? The delta is what? How much the call price will change for a 1 rupee change in the underlying, right? Up or down, the call price will change by the delta amount, right? So their insight was, SK, matlab, forget about this for now, right? So we just talked about the law of one price. We said that, hey, two things that have the same cash flow at some point in the future should have the same price today. And so these guys had this insight where they said, okay, let me just close the chat for a second. These guys had this insight where they said that, hey, either I hold a call option or I hold delta amount of shares. For small moves in the underlying up and down for a small period of time, they'll have the exact same payoff. Okay. So one sec. I'm just going to add another slide over here. This is making a big jump. One sec, guys. I'm making a big jump in terms of, I really want to make sure you guys get this concept. Okay. So one sec, guys. Just give me a second. It's not a very easy to understand concept, and I'm trying to minimize the amount of maths I use over here. I'll still show you some maths, but I'm really trying to minimize the amount of maths over here. Okay. So call is the same as delta shares. Okay. So which means that one call, if I buy one call, which is at the money, an at the money call has 50 delta, right? So it's equivalent to being long 0.5 shares. Yeah, I'm going to keep it in English. So being long one call, so this was their insight. Their insight was, hey, I can replicate the payoff of a call option by being long delta amount of shares for small periods of time and for small moves in the underlying. Right. So example is this. So now let me do something else. Let me create a portfolio where I'm long a call, I buy a call, and I sell delta shares, right? So this is my portfolio. So I buy a call and then I sell delta shares. Okay. So what should the value of this portfolio be in the future? Who can tell me what should be the value of this portfolio in the future? Excellent. I like it. If they have the same payoff, right, in the future, it should be 0. ठीक है? Because they're the same thing. अगर मैंने एक चीज खरीदी and if I buy one thing, just think about it this way, right? If they're exactly the same, right? If these two things are exactly the same, then in the future, they should be exactly the same. So if I'm buying one thing today and selling that other thing at the same time, but they're the exact same things, right? Then in the future, they should be worth 0, right? So now I come here where I say, okay, hey, you know what I did? My portfolio value at time T is I'm long a call and I've just sold delta amount of shares, right? So this is my portfolio at time T. Okay. And again, guys, you don't need to know this maths in order to be successful at option trading. But I want to really I talked to you guys about theta in the beginning, theta and gamma in the beginning, right? So what I'm trying to do now is I'm trying to get you to appreciate the fact that there is a very significant relationship between theta and gamma, and it'll really help us reason how we think about options. Okay, so my portfolio value at time t is this C minus I've bought the call and I've sold delta amount of shares, right? So C minus delta, which is the number of shares that I've sold, into S, which is the stock price, right? This is my portfolio value at time t. And then this is just arithmetic, right? My portfolio value at time t plus 1 is going to be what? Is going to be my value at time t plus 1. So this is the change of my portfolio. Actually, one sec. Let me clear this also. One sec. Made a small mistake. One sec. Value at time t plus 1 is I just noticed a small mistake in my slide, so I'm just updating it. Let me just update my slide. One sec. Just give me one sec, guys. Bear with me. Sorry about this. Okay. So now it's clear, I think. So my portfolio value at time t is, I've bought a call and I've sold delta shares. So it's this. But my portfolio value at time t plus 1, let's think this one is 1 second. Okay, 1 second later, my portfolio is, of course, whatever the price of the call is 1 second later, and then whatever the price of the stock is 1 second later, right? And I'm saying it's small enough that my delta has not changed. Okay, so very small moves in the underlying. This is my portfolio value at time t plus 1. Right? And then my change in portfolio value from t to t plus 1 is what? Is just this minus this, right? This is my portfolio value at time t plus 1. And then this is my portfolio value at time t. So I'm just subtracting. This is just arithmetic that's happening here. Like plus minus ho raha aur kuch nahi ho raha. You can actually just plug in numbers over here and reason about it that way also. Okay. Now, because I said that, hey, my call is exactly equal to delta times the shares, right? And I've bought one and I've sold the other, and I'm saying they're exactly the same. Then I've already asked you this, right? So 1 second later, my portfolio will still be worth the same, right? My portfolio right now, and then my portfolio 1 second later should be exactly the same, because I've essentially bought and sold the same thing, right? I bought and sold the same thing at time 0. And then, of course, 1 second later, if I bought and sold the same thing, my P&L is still going to be 0. Right? So what these guys did is they said, okay, now this equation, I'm just going to set it to 0 because it should be 0. Right? That was their insight. Let's set it to 0. And once they set it to 0, and then there is a little bit of maths over here. If you guys have studied if you guys have studied differential equations in maths, right? In class 12 maths, we studied differential equations. If you guys did CBSE, class 12 maths, you did differential equations, which was ordinary differential equations. And then I remember in my first year of college, I used Taylor's expansion is this concept called Taylor's theorem, right? So differential equations, Taylor's theorem, and then the third bit of maths here is partial differential equations, PDEs, which I learned in my third year of college, right? If you take, exactly, right? Nobody can remember and you don't really need to. You don't really need to. I'm just completing the circle over here, right? So based on these three concepts, what you get is this thing, which is, so I've taken this directly from this book, which I think everybody should maybe not read, but at least if you can, you should try to read. So basically what is happening over here, right? This guy, I'll just write this in words. Again, you don't need to know this, but I want to show you guys this because what am I saying here? Here, the equation is essentially vol into stock price. So this is the heart of the Black-Scholes equation. Volatility into stock price squared divided by 2. So sigma is the volatility, S is the stock price, this is my gamma, this is my theta. Okay? So let's clarify this. Nobody will remember. I understand, bro. So basically, what is this equation saying? This equation is saying that, hey, my volatility squared into the stock price squared divided by 2 into gamma plus theta is equal to 0. That's what this equation converts into. Okay? This equation, it comes from the fact that, hey, a call is exactly the same as being long delta amount of shares. And if I'm trying to measure the change in that portfolio of buying a call and selling that delta amount of shares, right? If you guys agree with me that the price of that portfolio is going to be 0, right? Because they're the same thing, then it devolves into this equation, which says that my gamma plus theta, some number. So you can write this as, one sec, guys, one sec. I'm trying to really like make this easy. Yeah, so just give me 1 sec. Trying to make it intuitive so that everybody understands this concept. The final thing is what matters. So what am I saying? I'm saying that some number into gamma plus theta equals to 0. Okay? This is what this equation is saying. Don't be alarmed by these symbols. Okay? This guy over here is your gamma, this guy over here is your theta. And this is saying that, hey, some number into gamma plus theta is always going to be 0. This is directly coming from that relationship that I bought a call and then I sold delta shares. Okay? Now, what is this sum number? This sum number is equal to my volatility into stock price. इसको हमने किया square. And then I'm dividing it by 2. That's what this is, right? So this is a fundamental concept that says that, hey, according to the Black-Scholes model, this equation will always be true. Some number into gamma plus theta is always going to be 0 for that particular option. And this sum number is what? Is the volatility into the stock price squared. And I'm dividing that by 2. Okay? I hope everybody is with me here. There's no, like, it's just an equation that came from that idea that, hey, call and delta amount of shares is the same thing. Same thing with a put. Put and a delta amount of shares is going to be the same thing. For every option at any point in time, I can find a delta amount of shares equivalent to that particular option that they both behave exactly the same, right? If they both behave exactly the same, then buying one and selling the other is essentially 0. And as a result of that, I get this equation. Okay. Now, we also talked about theta is dependent on IV, right? We talked about that in the beginning of the class, that if my IV is high, my theta is going to be high. If the IV is low, my theta is going to be low, right? If the IV is high, my time value will be high. If the IV is low, my time value will be low, right? We all understood that. So the PNL that's coming from my theta is dependent on the IV, right? If the IV is, like I said, if the IV is high, I'm going to make more money on theta. If the IV is low, I'm going to make less money on theta, right? And then, so I know, don't be like intimidated by these symbols, guys. I'm going to simplify all of these again, right? So ये जो sigma square implied है, this is just my IV. And this sigma square realized is my RV. Let me rewrite this. So it's easy to understand. So again, this is a direct consequence of the way we've created this situation, right? Of IV, RV, gamma, theta. Forget about this for now. Just think about it this way, that, hey, I'm still playing based on that understanding, based on that assumption that a call is the same as delta amount of shares. And based on that, I did some maths and I got this equation that some number into gamma plus theta is 0. And I have PNL that's coming from theta and I have PNL that's coming from gamma, right? So what we see over here is that this mathematical relationship between gamma and theta is now saying that positive gamma means negative theta. Does everybody get that? So let's say this some number was 2. So 2 into gamma plus theta equals to 0. Okay? Like this some number could be 2. So 2 into gamma plus theta is 0. Right? So what is the next step from here? The next step from here is 2 into gamma equals to minus theta. Okay? So the money that's coming from gamma is being offset by the theta that I'm paying in the case of buying an option. Okay? Like, I hope that makes sense. I hope I'm not losing you guys. I know this is like not the easiest topic, but it's important that we understand this, because what is this actually leading towards? Is leading towards, So what is leading towards is some part of my PNL is coming from theta and some part of my PNL is coming from gamma. Okay. What we are seeing here based on this equation is that from this equation, what we are getting is that gamma and theta, you add them together, the value is 0 up to a multiplicative constant. And that constant has this volatility term in it, right? It's just very basic arithmetic over here, right? A plus B is 0. Then A is equal to minus B. So there is an offsetting effect between A and B. And we are multiplying A by this number, this sum number that I called, right? So thoda aur bada kar dete hain. Let me just increase the size of this, decrease the size of this, and increase the size of this, right? So the interesting thing now is that this is a relationship that comes directly from the Black-Scholes model, where they say that, hey, volatility into stock price divided by 2 into gamma plus theta is 0. This is how we price options. Okay, this equation will always hold true. But there's a problem with this equation. Can anybody tell me a problem with this equation, which is, some number into gamma plus theta equals to 0, where some number is this volatility into stock price squared divided by 2. Can anybody tell me the problem? We know there are two kinds of volatilities, right? Implied volatility and realized volatility. Which volatility is this? Can somebody tell me? Let's get that IV. Everybody's saying IV. So We're seeing some chats here. Okay. So now let's do a little bit of a history lesson. Okay? When the Black-Scholes model was built, there was no concept of IV and RV. Okay? These guys said, कि, hey, the stock price has one volatility, is the volatility. Okay? That's what they said. They said there's only one volatility. What is IV? What is RV? They said the stock has a volatility. The stock moves according to a volatility. And that's just one number. Okay? They said that it is the volatility of the underlying over the life of the option. If the option is expiring 2 days from now, then whatever the volatility of the underlying is over the next 2 days, that's the volatility that we are going to use. So in a way, they were saying that is the future volatility of the stock, right? BT Rautji, it means their sum is going to be 0. Okay. So anyway, let me just finish this point. So the idea here is that Black-Scholes and Merton, BSM. So these three guys were like, hey, there's only one volatility. We need to know that volatility to price the option correctly. What is that volatility? Is the future volatility, right? Is the future realized volatility of the underlying, right? But nobody knows what that realized volatility is going to be, right? IV is again, what is IV? IV is the market's best estimate. IV is the market's best estimate of what that volatility the market thinks is going to be. We all know this, right? We all know this, that IV is just the market's best estimate of what volatility is going to be over the life of the option, right? So when the model came out, when the pricing model was created, they said that there is only one volatility. But then when people started using the model, we realized that there is an implied volatility and there is a realized volatility. Okay. Implied volatility is something that comes from option prices. It comes from demand supply. If a lot of people are buying an option, its IV is going to go up, right? All of a sudden there's demand for an option. The IV is going to go up. If the IV goes up, the theta is going to be higher, right? The higher the IV, the higher the theta. The lower the IV, the lower the theta. The higher the IV, the higher the extrinsic value, time value. The lower the IV, the lower the time value. The flip side, in the beginning of the lesson, we talked about extrinsic value is something that I'm capturing anyway, right? If I sell the option, I'm capturing that time value anyway. And what is going against the time value that I'm capturing is if the stock moves aggressively. If I've sold an option and the stock goes up, down very aggressively, if the stock goes all the way up, then I've lost money on the stock component, but I've made money on the theta component here, right? So the stock component, as the stock moves around, that is what's driving my gamma PNL. Okay, so my theta PNL is coming from IV and my gamma PNL is coming from the RV, the realized volatility. Okay, and that is what it looks like over here. So if you look at your theta PNL, this is my implied volatility into stock price squared into gamma. My gamma PNL is realized volatility into stock squared into gamma. So my PNL over here in both these cases, right? The PNL that's coming from theta that I'm collecting if I'm selling an option, and the PNL that's coming from gamma. If I'm selling the option, then I'm paying this gamma PNL, right? Because a move in the stock price is going to hurt me, right? If I'm selling the option, and it's the other way around if I'm buying the option. I hope everybody is with me. Okay, na? So in this case, this is negative, this is positive. So this is an example of buying an option. If I buy an option, I'm paying the theta and I'm collecting the gamma, right? And essentially, when I add these two together, right, when I say, okay, man, my gamma PNL and my theta PNL, and these are just directly coming from the Black-Scholes model, my gamma PNL and my theta PNL, when I add them together, everything about them is exactly the same except these two terms, which are my gamma PNL is coming from the stock price moving around, and that is related to my RV, my realized volatility, and my theta PNL is coming from the price at which I bought the option or I sold the option, right? In this case, this is a case of buying an option. So I'm losing money from my theta PNL, but I'm gaining money from my gamma PNL, right? So this combined PNL is given by this number, okay, which is half into gamma into stock price squared into this difference, which is realized volatility minus implied volatility. Now, put it in the chat, guys. What will happen if realized volatility is exactly the same as implied volatility? This PNL, this gamma theta PNL, what will this value be if these two are exactly the same? My realized volatility and my implied volatility. Zero. Okay? So think about it this way. Exactly, right? It's going to be zero. So when these guys made the model, when they made the pricing model Black-Scholes, they were like, there's only one volatility. If we know that volatility, then we can price that option fairly. That's what they said, right? If we know this volatility, then we can price this option fairly, right? But nobody knew what that volatility was. So the market said, okay, we think this is what the volatility is going to be. That is what we call the IV, right? In the future, we found out, okay, this is what the volatility actually was. That is the RV, right, guys? And this was a fundamental thing that we talked about, right? My PNL is just driven by IV and RV. IV is something that is the market's estimate. RV is what actually happened, right? When these guys built the model, they said there's only one number is the volatility. But the real world is different, right? Nobody knows what the volatility is going to be. There's going to be an estimate, there's going to be a prediction, and then there's going to be an actual value. And my PNL has these two competing ideas. One part of my PNL is this gamma part, right? And the second part of my PNL is this theta part, right? And they're both kind of butting against each other. One is positive, one is negative because their sum is zero, right? 2 minus 2 is 0. 5 minus 5 is 0, right? So if in this case, because the volatility is, there's only one volatility according to Black-Scholes, is the future volatility. So they always assume that the volatility is going to be the same, but it's not, right? If the volatility is the same, then my gamma PNL will exactly offset my theta PNL. Okay, whatever I'm collecting as theta is not edge. If I'm collecting some theta and these two are exactly the same, whatever I'm collecting as theta is exactly being offset by whatever I'm paying as gamma as an option seller. On the flip side, whatever I am paying as theta as an option buyer, right? I'm collecting as gamma as an option buyer. Like I'm making the gamma if these two are exactly the same. But if they are not the same, so this is the case of an option buyer. If they are not the same, right? This is going to be greater than 0 when RV is greater than IV, right, guys? So as an option buyer, हमको already पता है. We already know. I've already showed that to you in the Monte Carlo tool, and you guys have access to that Monte Carlo tool as well, right? You can see that. But this is the equation. The equation says, if my IV is exactly the same as my RV, I'm not collecting any theta. Whatever theta I'm collecting as an option seller, I'm giving away as gamma. On the flip side, whatever theta I'm paying as an option buyer, right, I'm collecting exactly that amount in my gamma. But if these are different, then I'm either making money or losing money, right? And there is, again, like there's maths over here, right? And I don't want to go too much into the maths. I've already shown you guys enough maths. Let me know, yeah, just let me know after this if it's like, if I need to simplify this even further, right? Because I will. So this is a fundamental concept. The concept is that when somebody says, okay, hey, selling options gives you theta, it only gives you theta if this relationship, IV and RV, are not the same, right? If they're exactly the same, then whatever you're getting as theta, you're paying as gamma as an option seller. Okay, fundamental concept in option pricing. This is fundamental concept about trading options. Never think that, hey, selling options is free. Okay, why? Because I'm collecting theta. Never think that, because you are paying for it in gamma. And the exact thing here is you just flip. Let me just change this, right? So this is the case of an option buyer. You're paying theta in this case. The option seller is collecting theta. I'll just change this. It's an image. I'll change it in the other one. So I hope it's like, I hope you guys are getting this concept. Like theta is not free if you're selling options. It's only valuable. Theta is only valuable as much as if the implied volatility at which you're selling it is high, and high relative to the realized volatility. Because my gamma PNL is given by this realized volatility, and it is always going to go against me if I'm selling options. Okay. So my final PNL, after there's like some arithmetic I do to this, there's some more maths I can do from here, and my final PNL just becomes this. There is no theta here. There is no gamma here. It just becomes Vega into this is the case of an option buyer, right? In the case of an option seller, it'll be the opposite of this. It'll be sigma implied minus sigma realized, which is, let me just put it here. Take a second. So this is essentially what I'm saying here is, let's go. So what I'm saying here is total PNL for option buyer is Vega into RV minus IV, and then total PNL for option seller is Vega into IV minus RV. This is what it becomes. Okay, this, and there is algebra here. If you guys are interested in the maths, I can share it with you, but you don't need to know this maths. Okay, you just need to understand this fundamental result, and I'll do this here also one second, so that everybody gets this concept and everybody internalizes this concept. Okay, there is no edge in selling options that's coming from the theta. Whatever you're getting as theta, you're paying as gamma if IV and RV are the same, and it's just entirely driven by, so gamma theta PNL for buyer is above. This is essentially gamma theta PNL for the buyer, and gamma theta PNL for the seller is going to be exactly this equation, but just IV and RV reversed, right? So it'll be half into gamma into stock price squared into IV squared minus RV squared. Yeah. So win percentage is an artifact of something else, and we can talk about that also. But the fundamental thing that I want you guys to understand, right? If IV and RV are exactly the same, then we are in Black-Scholes world. Okay, where there's only one volatility, IV, RV are exactly the same. Then whatever I make in gamma, I'm going to give away in theta. This guy, right? Whatever I make in gamma, I'm going to give away in theta as an option buyer. Whatever I make in theta as an option seller, I'm going to give away in gamma. These become the same, right? My PNL, my gamma theta PNL becomes 0, right? So this is something, it's a very fundamental concept. My PNL. So when we took the first, when I first told you guys about, what is driving our PNL, what's driving our PNL is these two magic numbers, IV and RV, right? And uh, uh, And anybody who thinks, that theta is my edge or I'm going to collect theta, you need to understand that you will only make money by collecting theta if you sell it at a higher IV than the RV. Okay? Because if they're the same, then whatever you're collecting as theta, you're giving away as gamma as an option seller. So this is a very, very fundamental concept. I've tried to minimize the maths over here, but I still wanted to show some maths because there was. So in the last lesson, what I had done was I was just like, okay, these are the fundamental things that you need to understand. Okay, you need to understand that gamma PNL plus theta PNL is always going to be 0. And whatever is going to be left over is going to be this, which is my Vega into difference between IV and RV or RV and IV, right? That's what I had said. I had said, okay, these are very fundamental things that you need to understand. But there were people who had doubts. How does that make any sense, right? So to recap, what have we done today? We've seen that, hey, the Black-Scholes model is based on this idea that you can replicate the payoff of a call option by doing something with delta amount of shares, right? If these two are the exact same things, if buying a call is the same as selling delta amount of shares, then their value shouldn't change over time, right? And because their value shouldn't change over time, I can get to this fundamental equation. I can say that, hey, this portfolio is always going to be 0. And you're going to have to trust me, or you can study the maths yourself. But there are like three mathematical concepts, which take us from this, which is, hey, the change in my portfolio. If I'm buying a call and I'm selling delta amount of shares, the change in my portfolio becomes equal to this equation, where my gamma and theta are very closely related. Okay? And that translates into this equation that, hey, this is where my PNL comes from, my PNL from gamma and theta. And it's like this is, and this is a fundamental equation in option trading. Okay? So I hope I've built some intuition around this fact that, of course, like it's not easy to, yes, Om, exactly. So seller loses gamma, gains theta. So Om has said this in the chat, right? The seller loses gamma but gains theta. The buyer loses theta but gains gamma. And the actual, you don't really need to check for these values, because these values essentially become this. Okay? The maths just works out in a way where all you need to care about is these two numbers, my IV and my forecasted RV. Okay? So this is the theory. My IV and RV will determine how much money I make. And in the next session, what we are going to do is, I think maybe on Tuesday, we'll take a live session in the market where we'll put some trades on. Okay, Tuesday, or yeah, maybe we'll do sometime this week. I'll share it. I'll share it in the Discord channel, but we'll put some trades on. We'll think about, okay, let's say we are selling options. We'll sell options at a particular IV, of course, right? And then we'll think about, hey, what we think the RV is going to be. There's going to be a forecast for the RV. We'll use that forecast, and then we'll watch that trade evolve over the next 1 month, 2 months. And we'll do like a weekly session. But I hope, like, just share feedback with me, guys, because this is not an easy concept, but it's something that you need to understand, right? If you want, I can show you the maths in more detail, step-by-step maths I can show you, right? But this fundamental equation translates into this fundamental equation again by just doing a little bit of arithmetic. And this is what we care about. We care about, for an option buyer, this is what matters. For an option seller, this is what matters. You guys have questions? Let me take some questions. You guys can also unmute yourselves if you want to. And because this is not an easy concept. Um, or you can throw questions on the chat. And I'm available in Discord for as long. And see, like, it's one of those things where you should probably read up on this on your own a little bit also. Open up Chat GPT or DeepSeek or whatever, Google. But this is a very fundamental concept that we need to internalize. We are never, theta is never free. The price for collecting theta is gamma. And how much extra theta are you collecting over gamma is given by this IV, RV, and Vega. Watch this video again, guys. I'll share the recording with you guys, but watch it again. And then tell me what you guys understood, what you guys didn't understand. And listen, everybody has to get value for their money, right? So if there's anything you didn't understand, any doubt you have, please feel free to ask. Okay. So this week, what we are going to do is I'll share on the Discord group. We are going to, yeah. So this week on Discord, I'll share the date time, and then we'll just put some trades on. We'll put some trades on. We'll look at the IV when we put the trade on, and then we'll record the stock price when we put the trade on. We'll do it in Nifty only. Yeah, we'll record all the parameters, and then we'll just see how that trade evolves. And I'll manage the risk. And whatever I do, I'll just keep doing it in a live session with you guys. Let's just watch this trade evolve. All right, guys, heavy material, right? If anybody wants to see the maths, let me know. I'll put all the calculus in and show you guys. But like I said, you don't need to know the maths to understand this. It's more, we need to understand when options are expensive, which is driven by IV. When options are cheap, again, driven by IV, compared to what the RV we think is going to be over the life of the option. And that is what will drive our PNL in the long run. Okay, so it's just there was confusion. So I thought, let me try to see what's the best way to present this concept without complicating it too much. It is a complicated topic. So I'm sorry if, I'm sorry if I couldn't simplify it as much. And if I couldn't, just let me know and I'll think about it a little bit more. Okay, how can I simplify it even more? Maybe I can build some tools to show you as the stock price evolves, what is my gamma PNL, what is my theta PNL, and then what is my actual PNL that comes from there with different, maybe that's not a bad idea. I'll build a tool where you can actually, just evolve the stock price, create a simulation which is evolving the stock price. And then you can see that, okay, this is how much I collected in theta. This is how much I lost because of gamma. And then the difference between that is essentially going to be my Vega into IV minus RV, or Vega into RV minus IV. So that's what you want to take away. That, hey, I made some money in theta. I lost some money in gamma if I'm an option seller. And the difference between these two PNLs, if they are exactly the same, then I know that IV is exactly equal to RV. If they're different, then that difference is essentially my PNL. And that's coming from this difference between IV and RV. Whew. Heavy topic, guys. Heavy topic. Sorry. Yeah, absolutely, guys. You will need to watch this again to internalize and read up some content online also. See, it's one of the reasons, why not a lot of people who are trading options, there's very few people in India who are trading options who actually put in the effort to, understand deeply, hey, what is it that options are actually dependent on? What is it that your PNL is actually dependent on? And options are very, very complex instruments, man. Like I said, these brokers have made it very easy to trade options. NSE is also part to blame, where they just made it very, very easy to trade options. But options are complicated instruments, guys. Like uh, they're not simple things. You know, they're not linear instruments. They're complex instruments. So Hemant, excellent question. Which Vega are you using in this equation? It's the Vega at which I'm when I'm putting this trade on, right? Thank you, Ram. Thank you. Thank you. So, and this is something you can actually see, Hemant. You can actually just go on this thing. क्या कहते हैं? Just go on the strategy builder. Put in some values for IV and RV in the Monte Carlo tool. Put in some values for RV. Let me actually just show it to you. Let me just show it to you one sec. And see, like the reason this is not a scripted course is because I'm like really, in my mind, you know, all of you guys are beginners when it comes to volatility trading. Okay, so I don't really know. Then this is a complicated topic. How do you price options? You know, without complicating it with too much maths. So I need that feedback. You know, I need that feedback from you guys. Okay, you understood? You didn't understand? Okay, let me rethink. Uh, let me think again how I should explain this concept. Right? Just give me a sec. Let me just show you. And I'd shown this last time also. Just one sec. So let me just share my screen again. Google Chrome. Let's share. So, and this is like one of those things which is, you know, if I have to be really precise, I'm going to say, okay, hey, this is true on average. It's not true all the time. Okay, I sold a straddle. My Vega is 3761. Let's go into Monte Carlo. I sold it at 13.2. Let's make it 20.2. Yeah, I'm going to lose money here. So, how much money did I lose? 24,174 on average, right? On average, I lost this amount of money. The difference between IV and RV here is 7, right? 7 points. So, let's open the calculator. So this is 7 into what was my Vega? 3761. 3761. कितना दिखा रहा है? 26,327 I would have lost. And यहाँ पे it's somewhere around 24,000 rupees, right? So it's somewhere nearby because this is simulation and on average, this is going to exactly match, right? So if I run more simulations, it'll match. Let's change this now. Let's be like, okay, let's make it 10.2. Okay. So again, my Vega is 3,700, around 3,700. I come over here. I'm like, all right, this time I'm going to make money and it's going to be around 3 because the difference between IV and RV here is 3. So 3 into 3761. Let's do that. 3 into 3761 around 11,283, which is in the same ballpark. Like it's not going to match exactly, but it's in the same ballpark over here, right? I take more, run more simulations. There'll be some convergence, some up, some down. But this is roughly always going to be the case. Okay. I hope that makes sense. Any other questions, guys? Any other questions? I'm here. I'm here. Chalo, watch it again, guys, and I'll share some like book recommendations for you guys. There's nothing which doesn't have any like, which is like maybe I'll write a book on it sometime, you know, which is not a lot of maths in it. But yeah, so let's meet up again sometime middle of this week. I'll record it, of course, if you guys can't. Yeah, how do you forecast volatility in the Indian context? Good one, right? So the dumbest forecast is just use the IV, right? That's the dumbest forecast. A slightly smarter forecast is what we did in one of the previous lessons, where for Nifty at least, we saw, okay, this was the market's forecast and this was the RV. And then we made it into 10 different buckets, right? And we saw that, hey, almost all the time on average, the market is overpricing the forecast. How do we calculate India VIX? That's a good question. Um, it's like a interpolation between, they take a, so India VIX is calculated by taking IVs of different strikes and then taking, like, according to some formula, doing a weighted average of all these different IVs. If I remember correctly, it's like the 30-day upside calls. So OTM calls and OTM puts, they take a bunch of these OTM calls and OTM puts according to some pre-decided formula. And then they essentially take a weighted average of that, right? So that's how India VIX is calculated, and it's actually published. So at some point, I'd written some code that was replicating the calculation of India VIX. But it's just a combination of different IVs. So if all of a sudden there's a lot of increase in, if there's an increase in IVs across the board, India VIX will also increase, right? So it is sort of like it is sort of a representation of IV only, different IVs. Any other questions, guys? So forecast volatility in the Indian context, as beginners, beginner volatility traders, we're going to use that VRP template, and we'll be like, hey, you know what? On average, volatility is overpriced, and we'll position ourselves accordingly. Okay, so watch this again, guys. Do a little bit of reading also. Ask me questions on Discord. I'm also thinking very deeply about how to simplify these concepts even more, right? So we're going to be building some tools. The Excel I've been showing you guys in the last 2-3 sessions. I'm going to build a tool out of it so that you guys can actually play with it. And that's going to happen in the next 1 to 2 months. We're going to release a bunch of these tools so that you guys can play around with it more and get more intuition around this. I just got an idea for another tool over here, which is just creating this sort of P&L attribution to show you guys how my what happens if we are wrong and HV or RV goes up for the seller. Is there a point in time where we stop adjustments and move out? Yeah, that's a great question, right? um I guess it's like linked to what you think your max pain is going to be. And then you're like, okay, man, like I think we'll let's put some trades on. Let's put some trades on and let's do some scenario analysis along those trades. One thing that I've always done is, always as an option seller, I've always carried business insurance. And what do I mean by business insurance? I always buy more options than I sell. You know, so uh, so having that sort of flexibility, always on the lookout for cheap options and always making sure you buy more than you sell. That's sort of uh, something that keeps you comfortable even when, uh, and it's not always easy to do that. Sometimes when everything is just so expensive, you don't want to be paying money for those options. But yeah, one way of playing this trade is saying, hey, this is the maximum I'm willing to give up in this particular trade. And if that's how much I lose, that's how much I lose. Sometimes you're just going to be wrong, right? Trading is never, um, and and there's like some subjectivity here as well. Um, everybody has a different risk tolerance, right? So the realistic part over here is that even delta hedging is a perfect example, right? So adjustments that you're doing, these delta adjustments, um, it really depends on um, how much variance you want to take, right? So some people are just like, you know what, I'll just write the variance. I don't care. Um, some people, when I used to trade for a bank, like for my prop trading fund, um, for the bank and the prop trading fund, our mandate was you have to hedge your deltas at the end of every day, right? So these are all like risk tolerance questions. As long as the trade that you put on had edge, and as long as you keep doing that, in the long run, things will work out. Short run bad luck will be there, right? So I'm sorry, there's no like precise answer here, right? Tanmay, if you're looking for, hey, if it goes up by 4 points, yeah, sometimes you're wrong and you're just like, okay, man, my forecast was this, but it's already moved so aggressively in this manner. I'm like, you know what, just get the hell out. My forecast was really wrong at this time. And you could look at that from a P&L perspective. Uh, you could look at that from a RV perspective, that hey, this is the RV, annualized RV right now. This was my forecast, and it's like way, way, way different from my forecast. But the interesting thing is, if you get wrong, if you're wrong, uh, you can get out of that trade. But now what has happened is, because of that increase in RV, IV would also have increased, right? So that creates an interesting opportunity for you. Okay, let me just get out, but is there an opportunity now to sell, right? So that's the more interesting question. Chalo yaar, let me just get out. If RV is there, I've probably collected some deltas with it, right? So let's say you hedge your delta out and you're like, okay, you know what, I'll hedge my delta out with options. And that means maybe restriking. Like, I sold ATM. Now all of a sudden the stock has moved. So my ATM is not really ATM anymore. It's like my put is deep ITM and my call is OTM. Right now I'm like, okay, let me just like restrike and get back to ATM. But now the IVs are going to be higher because the stock has moved aggressively. Right. Um, at least they should be. If they're not, then maybe you should think about buying. Okay, hey, if the IV is the same and the stock has moved so much, it's realized so much volatility, let me just buy on the other side. That's also a valid way of thinking about it. See, there are people who, and we've also done this in the past. We have like forecasts, we have models that forecast volatilities, and then we decide whether we want to write the variance or not. But um, before you actually decide what to, code up into an algo, if you're looking at the RV and IV space, um, you want to probably like at least be in the cockpit for a few sessions and actually see these numbers change, because these numbers are going to be so new for you guys. For somebody who has never looked at the markets, never looked at options with a volatility lens, getting a feel of, hey, how are my deltas changing as the stock is moving around? um, IVs are changing. How is my P&L changing as a result of that? Uh, all these are very like, I would advise you guys to trade this. Look at the screen, trade it, watch the numbers change, and get intuition. Once you start getting intuition, then you can decide what part of this I can automate, what part of this I can systematize. All right, guys. It's dinner time at my house, so I'm going to eat something. Um, let me know. Let me know. Yeah, so that was an interesting time, right? With the budget. Um, Friday there was like this huge crush in wall, right? But wall had been going up until like since in the last 2-3 weeks, wall had slowly been creeping up. But there was an interesting crush a day before. That was really interesting. I'm not really sure what caused that crush. And the budget itself was kind of um, I mean, there wasn't really much that moved the markets very aggressively, right? Um, the major theme was, hey man, middle class needs some relief, and they got some, I guess. But yeah, nothing to really move the markets that much. It would have been a good sell on Friday. Wall would have been a good sell on Friday. Definitely. All right, guys, dinner time. Happy Sunday. Watch this video again. Ask me questions. I'm always there on Discord. Um, it's not an easy topic. So Put in the work. Put in the work. Bye. Endless.